Happy Monday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Monday, May 6th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So today's key macro event is global macro cross currents are getting increasingly hard to position for. So the nuance there is Friday's jobs report was the dovish elixir asset prices needed after a week of conflicting catalysts on the policy front, specifically to Fed and Treasury divergence. The data were disconfirming of our sticky inflation theme while also being supportive of our resilient U.S. economy theme. The ISM Services PMI report provided the exact opposite signal of the jobs report in terms of fanning stagflation fears. Elsewhere, the final composite PMI data for April composite PMI data from around the world were generally supportive of our green shoots globally theme. In terms of market implications, so it is getting increasingly difficult to figure out where asset markets are likely headed based on the evolving fundamental outlook alone. The growth, inflation, and policy drivers of asset markets are no longer ubiquitously pointing markets in one direction or another. We honestly feel bad for investors that lack sophisticated risk management systems to guide their portfolio during confusing times like these. As always, transitioning to our 42 Macro dashboard, wrapping up with the question from our community. This one's regarding fundamentals driving the cooling of yields in the last week, and it reads, what could be the fundamentals driving the quite interesting cooling of bond yields in the last week, especially on the 10-year, if the fundamentals are driving it. So our take on that is obviously we had the Fed surprise markets twice last Wednesday, both with respect to its dovish policy guidance, but also with respect to the timing of and size of changing its balance sheet runoff policy. I recall that they are going from 60 billion in treasuries of runoff per month to only to 25 billion. So, and this is again in the context of a series of sticky inflation data points, in our opinion, some significant degradation in terms of the supply side healing that Powell continued to talk up at Wednesday's FOMC. And then obviously on Friday, we got the first miss in both payrolls and wages since I want to say October, November of last year. So those are, that clearly dovish signals in terms of the Goldilocks jobs report supporting the dovish market pricing in the USD money markets. So that was, in our opinion, was one of those things that have driven, was a primary driver of the decline we saw in bond yields last week. So we'll wrap it up there. Darius Dale presenting our macro minute for Monday, May 6th, 2024. Everyone have a wonderful day out there. Best of luck. We'll catch you back here tomorrow. Cheers.